So from your first cycle of investment, which was starting with the $10 million,
Yeah.
and until now, has it become easier, or is it like because of the scale that is involved now, there's like more moving parts and it becomes more difficult?
That's a very good question. Sometimes people who just criticize just because they love criticizing. I don't think people understand what VCs are. There's so much stigma and criticism and, opinion about what we do. Actually, we're entrepreneurs. It's impossible to be 100% right about people all the time. Because entrepreneurs, they're human beings at the end of the day. They have families, they have obligations, they have dreams. People change, man. People change.
Welcome to the Sandpit Startups podcast, where we journey into the minds of the brightest and the best the region has to offer. We're here to connect the entrepreneurs in the studio with the entrepreneurs listening at home, and our mission is to motivate, educate, or inspire you. And if we do, you know where the follow button is.
Welcome to today's podcast episode. We are thrilled to introduce our special guest today, Walid Mansour, the co-founder of Middle East Venture Partners. Middle East Venture Partners is one of the largest and most active venture capital firms in MENA. And they have an impressive portfolio of companies they've invested in, from Anghami, Invygo, Fresha, MamoPay, and the list goes on. So today we'll discuss things about VC, the mindset of a VC, and also we'll talk about the startup ecosystem as usual. So thank you, Walid, for joining us on this podcast.
Thank you. I'm very happy to be here.
It's our pleasure. Starting you off with a very challenging question, although maybe it might sound a bit simple. We'd love you to summarize sort of your journey to this point through everything that Abhishek's sort of briefly mentioned just now.
So, summarizing a journey. How much time do you have?
Good luck.
I belong to a generation that never knew what venture capital entrepreneurship was. And I was on a path of being a good student, did engineering studies, went into the world thinking that, it's a linear path. But then I started with time discovering that, no, life is not linear, jobs are not linear, careers are not linear. And around the year 2005, 2006, I moved back to the Middle East. I spent many years abroad and fell in love with the ecosystem that was being built up here. So Dubai in particular was a high energy, high electricity, city, crazy projects, amazing outlooks. Yeah. Honestly, I didn't believe 90% of it. But what's funny is that today you see that actually that vision was
it's here.
Executed, came through really, through basically they powered through it.
Yeah.
And around that time, I started seeing some of the early, signs of entrepreneurs who wanted to raise capital. Some amazing names back then. It was, you had some amazing entrepreneurs, people who founded Maktub, people who founded Souk, people who founded Dubizzle, all these kind of early entrepreneurs. And we used to meet up. I was actually very lucky to be, kind of in that initial ecosystem with a few of us. And we quickly realized that this region doesn't have any venture capital money. Right? So there was a few angel investors. There was some syndicate groups,
some
very basic
offices,
stuff.
Perhaps.
Not even family offices. It was just people.
Okay.
I mean, people would go around raising $10,000, giving away 10% of their company, $100,000. You could have 60% of it. It was wild days.
Very.
Yeah. But then, in the midst of this craziness and in the midst of this transformation that this part of the world was going through, like all of a sudden it became clear that, there's a lot of building and infrastructure, but not enough people to fill them with stories.
Yeah.
Right? So, and around that time, the whole iPhone revolution apps revolution, 2007, 8, 9, was starting to happen, right? Because we went from a web world and just started getting into a mobile world. We went from a world where even technologies, cloud technologies were being, deployed. Engineering talent was becoming more and more available.
Right.
And it was clear that there's an opportunity in the internet, right? That's how we saw it. And we came and said, you know what? Instead of having this archaic funding, let's copy the best. Let's get the best venture capital models, the Silicon Valley, the GPLP model, to this part of the world. There was about 100 private equity companies back then, 2008, 9, right? It was the boom of PE. There was nothing in VC, and we said, let's do it. But we'll do it the right way. We'll get the actual
blueprint of it.
Yeah, exactly. Silicon Valley playbook. And we were the first. We were the first venture capital, first GPLP structure in the entire Middle East. We started off with a $10 million fund, tiny fund, barely profitable. It took us 7 years to get to a sustainable profitability level. 7 years before, because every time we were, investing and recruiting and launching ideas and launching funds and, putting capital at work. And that was 2010 when we launched the first fund. And then we kind of promised ourselves that whatever we're going to do, we're going to do it in the best possible way we could. So we said, it's important to be true to our governance, because governance is key. The capital does not come into a company that's not well governed. So we put a lot of emphasis on governance.
Okay.
How does the investment committee work? What is it made of? A GPLP structure, what type of LPs do we want?
Right.
Can we invite what we want?
Okay.
Right? What is the role of the GP in terms of investments and beyond? Right?
Yeah.
How do we build the pipeline?
Right.
Like, where do we get the pipeline from? Like, is there enough pipeline? Tech companies or digital companies? We had to really solve, how do we change laws in certain countries? Like many countries around that time didn't have any supporting legal infrastructure.
The regulations were very tight.
Things like stock option plans, never heard of.
Oh yeah.
Things like bankruptcy laws, which were incredibly harsh in many countries. Like, it would put off any entrepreneur to put any, let alone the social construct around failure, the social pressure.
That's a
tough one. Yeah. Then not enough venture capital money, because what can you do with a $10 million fund, right? What is it, like, how far can that take you?
Yeah.
Right?
Right.
So I guess we were crazy enough to get to it.
Yeah.
And honestly, we haven't thought through these questions back then. Okay. Right? Back then, we just enjoyed the ride.
Yep.
Thought we were doing something cool. We haven't thought through a lot of the stuff that will come up later. So how do you scale? How do you get, because this business needs scale, right? You can't function over 15 years if you don't get scale, because you need to recruit people. You need to recruit amazing people, people better than you, that know stuff, that know how to, build a pipeline, follow on it, invest, execute, add value, because you can't do everything yourself, right? You need to have the lawyers, you need to have the auditors, you need to have the compliance people, you need to, it's just,
Sure. So as you were discovering the blueprint of the VC structure and the whole organizational process, so if there is a way from your understanding, if a layman has to understand how a VC actually functions, because we always see it from the outside as entrepreneurs. So from the inside, if you could share some insights.
Great. Yeah, I'd love to do that. Actually, I don't think people understand what VCs are. There's so much stigma and criticism and, opinion about what we do. Actually, we're entrepreneurs.
Yeah.
We're entrepreneurs. And every fund we raise is a company on its own. right? Because every fund we put together and we have investors, and it has investors, has its own strategy, has its own issues,
Yep.
right? Has its own journey. It has to exit.
Right.
Not once, but let's say you have a portfolio per fund of 15 companies, you have to exit 15 times per fund, right? So you have
High
4 or
pressure.
5 funds. That's, So we're basically, entrepreneurs. Every time we put this together, of course, it gets a little bit easier because of the track record. So think of it like, second fund is like a second time entrepreneur, third fund is a third time. But
for example,
it's never guaranteed, right? Because things change, markets change, competition comes in, pipeline changes, stories die, countries rise, countries fall, currencies impact you.
The macros,
Oh, man, it's tough.
So from your first cycle of investment, which was starting with the $10 million, and until now, has it become easier, or is it like because of the scale that is involved now, there's like more moving parts and it becomes more difficult?
That's a very good question. I think certain aspects of it become easier as you go.
Okay.
Because experience matters.
Yeah.
Right. But in particular, in our part of the world, we had to build that venture capital industry. Right. We had to prove it works.
Yeah. To be the pioneers.
Yeah, exactly. And it's funny when people compare you to other parts of the world and they say, you know what, that exit was lower than a Facebook exit, or like you didn't get 20%, you got 12%. I was like, yeah, dude, come do my job. Then we talk.
Yeah.
Right? Come. I'm really looking forward to that. Especially coming from people who have nothing to do in this in this space, or basically washed up entrepreneurs, or somebody who's never done anything useful, or sometimes people who just criticize just because they love criticizing. Come on, do. I'd love you to see doing that. Please, let's do it. Right? I've never seen a rich person, very rich person, criticize. Right? It's all poor dudes. And I'm not saying this to be mean. I'm saying just like honestly saying this because we put so much at stake.
Yeah.
Or we're entrepreneurs, and we have to prove that it works. Because the family office, the high net worth individual, the employee that trusted you with their money and their funds, you have a moral duty to do your best towards that, right? And you're operating in an environment where you don't have enough entrepreneurs, enough talent, in a region that's not digitizing fast enough, fragmented, multi-country, multi-currency. You're dealing with an absence of exits, absence of IPO markets, absence of, your only way out is through basically trade sales and you're doing it 15 times per fund times, I don't know how many funds you want to raise. We raised 5 funds in our journey. So, invested over 15 years, close to 100 company. We put in from our own funds close to $350 million at work. And we attracted $1.6 billion of co-investments into those companies.
What do you think the key is to attracting so many investments? If you've done it so many times, there must be common occurrences.
Every time is a new story. Every time is a new story. Because, what was sexy 15 years ago, today is,
But there must be core principles that investors are looking at that don't change in their sexy levels over time. There must be like, okay, this actually...
So here's our journey. We started with attracting first believers, friends and family offices, and we're very thankful for their, investment.
Yeah.
And I think we did a good job with it, right? But then things become more interesting as you scale, because you can't go for a family office to build a $150 million fund. We're talking about early stage, right? Or $200 million. You need sovereign wealth funds. You need pension funds. You need large family offices, multi-billion dollar. And those guys, those institutions, especially when they start investing globally, they're looking at the MENA opportunity. They need to be convinced that it's a real opportunity,
Yeah.
right? So when we knock the door, when we're knocking the doors of some of these sovereigns, it took us 18 months, 2 years, 3 years of coming back before they even changed their mandates, because some of these sovereign wealth funds didn't have mandates to invest in VC. They had mandates to invest abroad as part of their capital preservation, strategy.
Right.
But none of them back then were, ready to deploy Now you have, right?
Yeah.
You see what's going on in Saudi. You see Abu Dhabi, Dubai.
Yes.
You see, all over the region, how game-changing money came into this industry. You see a lot of VCs coming to life, partially, thankfully,
Yeah.
to this move. But that took years of proving. Because first question is, where are the returns? Second question, where's the pipeline? Where are the exits?
Right.
Who's running this? What's your governance model? Who are your, partners?
Yeah.
What's their story? Are you well capitalized? Are you going to sustain 8 years into this journey? Because most funds, they say they're 8 years, but end up being, 12, 13, 14 years.
Yeah.
Like some hard questions. How much are you committed? Are you putting your own capital into the funds? Yes, 2%, 3%, every fund, cash, our contribution.
Difficult to navigate that.
Not easy.
Not easy at all. As an entrepreneur, we always look at it from the other side. But as a VC, you also have a similar ecosystem where the pressure is high. There is a mandate, and to raise funds like any startup would.
I'm curious because you said it took 7 years to sort of get to a sustainable profitability point of view. Is that typical for a venture capitalist? Because there's a stigma out there that it's like a bottomless pit of money. Like, what's the reality?
A VC firm is a company that has employees, partners, collaborators, expenses, compliance, legal, offices. It's a company, right? Has a P&L,
Yeah.
right? And especially if you have the ambition of scaling that company, it's like any tech business, right?
Yeah.
You can have a tech business with, enough money to sustain a small team. But then what happens if you need to scale? You go raise funds,
Yeah.
right? So think of us as a company. We're a company at the end of the day. We have sources of income that come and kind of cover certain needs. But if you want to grow, if you want to be in many countries, like we did, because we're a MENA fund. We have offices in Cairo, Amman, Beirut,
Okay.
Riyadh,
Yeah.
Dubai, Manama. Active presence on the ground, people there
Yeah.
covering those markets.
Yeah.
We get deal flow from all over the Arab world and beyond, Pakistan,
Okay.
Turkey,
Yeah. MENA. Yeah.
Sub-Saharan Africa.
Whoa.
People moving from Europe to UAE telling us, hey, I'm in Dubai, look at my business. Like, we do get today about 1,000 company every year. And we have to pick 5, 6, 7 a year. So we're a company. We need to build for those capabilities. We need to be present in those markets. So you need to keep investing in your business, right? It's not enough to say I got a 2% fee out of whatever that fund is. Depends on your plan. What is your plan? Are you able to service your strategy? If your strategy is MENA, you gotta be in MENA. If your strategy is, one country, then whatever your strategy is. So that's the aspect of VC that people don't see. There's an incredible amount of personal commitment and time and resources, financial resources and commitment and purpose,
Right.
to be able to get there. Otherwise, you can run a small fund and just be happy with it.
As you've seen, as you mentioned, that there are 1,000 companies per year, and you have been through various cycles. So you'll have perhaps seen almost every kind of startup that could exist. And of course, there is a mandate or a thesis that a VC goes with. My question to you is regarding first-time entrepreneurs applying to VC firms. So they believe that it's either angel investment or a VC firm that will fund my next big idea. and they come with crazy valuations. The entry point valuations are just based on an idea. And from your perspective, as you've seen many startups and you invest in startups as well, what is that key point or KPI that you look at in that startup to invest in?
Think of it as a checklist,
Okay.
right? So you have this, you gotta choose the right checklist for the right stage. Give you an example. If you're IPOing a company, right? And we did 2 IPOs, one in Nasdaq, one on the London Stock Exchange, right? It's a very interesting process to go through. The valuation is really function of your financial model.
Okay.
How robust and solid your financial model is. And you can model because by then you have 10 years of data, you have cohorts, you have, the whole, and you have investment bankers, big names and big law firms and big, advisors around you, and they kind of put a range, and then you go build a book and right. Yeah. But then as you go down that that stage, Series D, Series C, Series B, Series A, seed, pre-seed, that checklist changes dramatically, right? It becomes less and less quantitative driven, more and more, you look at other stuff. So to give you an example, a seed company needs $1 million, $2 million to build a product. There's no product yet.
Yeah.
We need to build it. What do you look for as a VC? Like, first of all, it has to align with your mandate.
Yeah.
Right? You have to be very disciplined. We say no to a lot of companies, a lot of trends that are not within our mandate. Okay. And they end up being incredibly successful businesses, right?
Right.
Doesn't have to be. Just our mandate is, XYZ. You have to stick to it because as a company, fund, EVC, you've laid down that strategy to get those returns based on that mandate.
That's your manifesto, basically.
That's exactly your ethos. Exactly. Yeah. So a company needs $1 million, $2 million to build an MVP. So first of all, I always start at the size of the opportunity. And I spend an incredible amount of time trying to understand the size of this. So people call it TAM, addressable market, that kind of stuff. I think it's an incredibly hard exercise to do, especially when you're dealing with new habits, new products, new innovations, adoption rates, what would be the future adoption rate of a certain technology in that part of the world, right? Is it going to be 1% or 10%? Because there's a huge difference, right? Yeah. What is its monetization potential? Is it, low, medium, high? Because that, So after getting some comfort on the size of the opportunity, if the opportunity size is $1 billion, we go for it. If it's $100 million, it's not for us.
Okay.
And there's a reason for that. I can come back to that later. But then that's kind of the first thing in the checklist, alongside, of course, the entrepreneur and the people behind the journey. Yeah. And from experience, I've learned that it's impossible to be 100% right about people all the time. Yeah. Because entrepreneurs, they're human beings at the end of the day. They have families, they have obligations, they have dreams. They get tired. Some of them are purpose-driven. Some of them are, money-driven. And it's almost impossible to know that stuff, without spending
good time with them.
Good time, and by mean significant time. And not in a relationship of, I'm your investor, I own your... No, not talking about that, because that comes later with the governance and the paperwork you sign and that kind of... She's really spending time with the people behind it, right? Because I've seen all type of... I can't say I've seen it all, but I've seen a lot of type of entrepreneurs, and a lot of type of entrepreneurs who also change their minds. Some of them fight, some of them are tired, some of them get sick, some of them, leave. Some of them are terrible executioners. Some of them are tyrants with their people. Some of them are too nice. As if the perfect entrepreneur does not exist, right? So it's a skill set. But we try to look a bit on the teams behind every company. So up high with the addressable market is people. People can they execute, right? What's their track record? What's their capability? Who are they? Are they gonna stick to it on the long run? Because a pre-seed deal is a 10 to 15-year-old journey.
Okay.
I mean, you could be lucky. You can exit along the way, and I'm not talking about BS exits like Aqua hires, merge with another company, that kind of situation. Like a lot of it here, a lot of people here, and portray this as this heroic act. It's great that you merged and exited. I'm happy for you, but I'm talking about the real deal, right? The oversized returns, because every time we look at that checklist, we have to make 15 bets, 10 to 15 bets per fund, right? A big percentage of them will fail, will get you maybe between 1 to 3 times. A good chunk will get you 0. And you basically make your returns on the oversized outcome. So oversized outcome at the early stage is size of the opportunity, people.
Okay.
Then you go into Series A, Series B, then you have a product, right? How's this product doing?
Yeah.
Product market fit, marketing market fit.
Yeah. Founder market fit. Yeah.
Exactly. It's just like this whole fit, right?
Yeah.
What does that mean? That means is the thesis playing out? Is your service, app, product being adopted? How do your cohorts look like? Do you have churn?
Yeah. And then you have enough data to actually
start building a model. Yeah. And that data, and also you also can also start digging deeper, because you have to go in this job, you have to go 1 or 2 layers down.
Yeah. Make it more
right.
granular.
It's not enough to be. You have to understand whether your product roadmap is consistent with this product market fit. Do you have natural pull? Because I'm a big believer of timing.
Yeah.
Right. Everything is timing. That's it. Even exits.
Yeah.
Right. There's incredible exits here. Companies who exited at crazy outcomes, and when you ask them how much money they had in the bank at the time of the exit, they tell you a few weeks. You're like, wow. And I've seen those because I was invested in some of them and had the insider information. Yeah. So timing is everything. Timing is on exit. Timing is on. But you have some companies who their products gets an organic pull, right? 80%, 90%. Yeah, great. Why? Can't explain it. Timing.
Yeah.
So that's half of the equation. Some of it, have very low competition, just because maybe, competition was bad or.
Yeah.
So and then you go from the Series A to the Series B, and then you kind of start around the Series B. You actually the company start looking like a proper in terms of modeling.
It's almost getting mature now.
It's almost getting mature. You hopefully you have a good finance team that's able to get a grasp on the number. You have a story you can tell. You have an equity story you can build.
And you have 4 or 5 years of data, which is basically
and you're hopefully
to forecast.
Exactly, and you're hopefully making $10-15 million in turnover or whatever that you're doing. So that's very sizable, right? Because
So your firm often talks about not just throwing money blindly at projects, but really being the right fit for them. And there was a couple of key ways that you do it. So one I picked up on was patient capital and smart capital. In layman's terms, what is smart capital?
I think we should change this term to right capital instead of smart capital. Sometimes being too smart works against you. I think what that means is that you have to get an investor with you, a venture capital investor with you, who's been in this ride many times, who's able to be your kind of your real partner in this journey, right? Because it's never about you. It's never about you alone. I mean, the worst companies I've been into have been led by high ego founders, entrepreneurs, driving their own agenda. It's never about you. At the Series B, Series C, pre-IPO, it's about something else. Yeah. It's about you have a company that are hundreds of people, hundreds of destinies, that's going after certain markets opportunities. So and I'm a big believer in surrounding yourself with the right people in your personal life, in business.
Indeed.
If you don't have 5 people around you at any point in time, they don't have to be your best friends. They don't have to be your drinking buddies. 5 people around you that you surround yourself with, that you constantly interact with, you somehow tend to become the average of those 5.
True.
So if you pick 5 of the best,
Yeah.
you kind of, your average is trending upward. If you pick 5, bad people, then, and think of it as you got yourself the best investment. What is the best, right? What is it? What does that mean? Is it ability to raise money? Is it ability to give good advice, open doors, network, bring talent, support and product? So one thing, for instance, we can help with seeing 1,000 companies is we got data that nobody has, right? Chances are we saw something close to you, similar within the category. We have an idea of what's going on, especially in the early days, incredibly useful. And the list goes on what being smart is, right? Sometimes being smart is being supportive, right?
Yeah.
Support you with cash, resources, time.
And sometimes the startups which are there in the portfolio can actually help each other out.
Yeah, that could happen. It's not that obvious though.
Okay.
There's a lot of, we encourage, I personally am a big believer of this, surround yourself with 5 people theory. So if you find them within that ecosystem of our companies, then that's great, because you have other entrepreneurs or founders who've gone through similar hardships or stories, and that could be useful. But that's the smart part. Like, it's think of joining a VC, you're joining a network.
Yeah.
Right? You're subscribing to a network.
Yeah.
Do you like that network? Great. You don't like it? It's not for you. Right? That's the smart part. That's I think what it really means. I think it should be called the right part, not the smart part.
Yeah.
The right for you.
Yeah, because when raising funds, it's like a lot of founders would just jump at like a big pot of cash. Like they'd love to just get the investment. It doesn't really matter where it's coming from or who's behind that. So I think, just making sure it's the right.
Some people are
partnership.
married to valuation.
Yes.
They're married to the number. Some people, exactly, get the cash too quickly. But in hindsight, you can never know, right? Because who knows? Nobody reads the future.
Right.
Again, it's timing. Like, half of what we do is timing. Whether it's product timing, market changes. I can give you examples. Like, early on, we invested in a gaming company that was built on Facebook gaming environment. Remember when Facebook was a gaming platform?
Yeah.
And then the guys at Facebook woke up someday and say, you know what? We're back into social. That kind of destroyed a whole. That was tough for that company to repurpose itself into mobile. They ran out of cash. Mobile was picking up. Facebook kind of, started. So that's an example of timing. And the lessons learned here is on platform dependability. But, nobody expected it to. Even in the early days, when Google... When we invested in web-based companies and content traffic-based companies, we used to wake up to these Google changes, pandas and what have you, and then all of a sudden your traffic is down or up or in a crazy. So there's stuff you can never control, although the story is beautiful, the market is there or seems to be there, the people are smart, dedicated. Half of it is time. Exits, same story.
Absolutely. As you mentioned, there are certain times the macros also play an important role. For example, there was the COVID period. Some startups didn't do well, but the quick commerce startups came in, and that time was optimum for them. And even the other startups which weren't into that got into that space. I remember that even Sharaf got into grocery when they were in electronics. So there was the indication that there was a market there which was created through a macro cycle which didn't exist then. So it's either or. However, I'm sure that being in this business for so long, you will be able to get a sense of an entrepreneur when you meet them with the ideas, because for sure the first venture cycle, the startups that you had, was part of the learning curve, but now you are expanding in other parts of MENA as well. So there must be a common thread in terms of characteristics of an entrepreneur or an idea which you feel that this is the next big thing, or they are the next big thing.
I guess you get better at it with time, but there's no formula.
Okay.
There's no formula to how people will behave or what chemistry looks like.
Right.
Right. There's also what you're looking for, because it's two-way. As an investor with a mandate and its thesis, and say you want to focus on on-demand businesses, groceries, and what have you, you got to go and look for those who can make that happen, right? But you can never. People change, man. People change. That's the only constant in our journey is that I've seen entrepreneurs who are incredibly great friends and then overnight, go in a complete different direction, driven by, I guess, greed, ego, misguided, and drove their companies to the ground. Okay. And I've seen this so many times over the years, so many times, and I've also seen the opposite. I mean, I've seen entrepreneurs who've gone the other way, started a bit on shaky grounds, but that got better with grit and persistence, and they build up character, and they build up people, and they build up capability, and they run extremely successful companies, and they've been through hardships, up rounds and down rounds and cycles, and
So that seasons.
I don't know. I wish I knew if I knew what the formula was, I'll only just apply and become a billionaire.
Just copy paste and
copy
make
paste.
money.
It's people, man. It's people.
Yeah.
One of my mentors told me someday, people make money but people lose money, right? So it goes both ways. You just in this business, you really hope that those who make money make more than the one who lose, because at the end, that's what you're netting.
So a big part of, as you've mentioned, the way that you sort of look at opportunities is looking forward into how big the opportunities may be. What do you think and what do you see as some really big up and coming spaces?
It's not an easy question. I'm a big fan of two trends meeting at the same time.
Okay.
The first one is people changing habits, and the second one is products, technology upgrades.
Nice.
So you spoke about grocery delivery, and I'm actually happen to be invested in an amazing company in Saudi Arabia called MENA. It's a leading grocery delivery company that has been through so many iterations, and it got its moment under the sun when COVID hit, March 2020. And March 2020, we put out a press release announcing the Series B for MENA. It was a $20 million round, or something. I forgot the number. But that deal had happened a few months ago. The press release got delayed, and it just happened. That was out in March and April 2021. Then started getting all these phone calls congratulating us on how genius we are because we did online grocery in the middle of COVID. Reality is that PR was just delayed. Nobody knew a pandemic was on the door, and let alone that we'll be locked up in our homes, and all of a sudden, guess what? Grocery delivery is hot, you know? So that's a fun story. Reality is it's an incredibly hard business to build. With margins that you need to defend, operations that you need to defend, technologies that you've built. And that's a good example of two things happening at the same time. All of a sudden, people waking up to grocery delivery and downloading and using it and becoming, that's the first trend. But that the second, you got to build a product, right? So you got to have the technology that allows you to it. And by then, Saudi Arabia had, complete payment ecosystems, fully digitized, with the introductions of MENA and all these, so debit cards were working. You had a few years of mobility startups and apps and, that kind of built the fleet. You had certain support on regulation when it came to certain Saudization, so you had also a product that's kind of a technology that's kind of maturing that's meeting a trend. Right. And when you have these two at the same time, then you have a business you can bet on. It becomes an outsized outcome. So the question is moving forward. It's like, how do you what would people do 5 years from now, 10 years from now? Will they speak to a digital doctor? Will they just drop this visit, to the doctor and just go and rely on a doctor app that is an AI digital twin of a doctor? Like, maybe.
Yeah, it's a bet.
Could be.
Like you
It's
said.
a bet. Could be age driven, could be country driven.
Yeah.
And at the same time, do we have the actual
Tech.
AI capabilities, infrastructure, regulation? Our job is to kind of look at this stuff, think about, obsess about that stuff,
Yeah.
and see, what, this is where the world is going. You could come and say, you know what, I'm not touching AI because I don't have the understanding to build AI infrastructures and language model and neural links model and what have you. What I'm gonna focus on are applications, and I'm gonna look at, the same way we had digitization, and we still do, because the offline to online story in which we spent the last 15 years not over yet. In my opinion, is just starting. But then if you want to look at an AI, so online to AI, so maybe that's one, but that's another 15 years ahead, So those are the kind of the two lenses I personally try to apply to see whether it has a chance of standing. But, go back, remember the checklist?
Yep.
Yeah.
It's really like rough waters to navigate, honestly, because like even if those two sort of trends are going in that direction and they're overlapping nicely, that doesn't mean that like one legislation can't come out and just absolutely derail all of it.
100%.
It's new tech. It needs to be monitored.
Look at
in some
crypto.
way. Yeah.
Exactly.
Yeah. And behavioral changes too.
Yeah.
That often comes with
Yeah. I mean, in the case of crypto, some countries put in, like Bahrain, put in certain regulation, attracted companies. We invested in some, but then other countries are still a black box.
Yeah.
So that's an example on the regulation side.
Yeah.
But then I'll go back to that checklist, I think, and people.
Yeah. Why do you think this region is so hot for entrepreneurs right now?
Yeah.
You know what? I have a feeling that we live in an era. It's not just space; it's also time. It's space time, right? It's MENA GCC 2024.
Yeah.
It's not MENA GCC 2004.
Right.
Sure. Yeah.
Or 1990. Like, it's also time. Like, you can't. This was. So you have space time coming together, and I sometimes have the feeling that we're in this far west golden rush era. Everything is possible, right? Just take your shovel, try to go
Make the most of it.
dig some gold
yeah.
out, do some digging. Why? Because you have actually, when you think about it, we're in the middle of an incredibly rich and diverse region. Countries, people, population. Being in the UAE, for instance, you're at the heart of so many cultures and countries around you.
Yeah.
The 6 hours flight range is 2 billion people, 3 billion people, something like that. They all convert here. They all love doing business here. They all, at some point, want to be part of it. Entrepreneurs coming and seeing, more and more tech companies, more and more exits.
Yeah.
I want to be part of it. And I think that's amazing. It's actually amazing to be part of a story that's unfolding in Saudi Arabia today. Like, the energy, and
shifting slowly.
they're shifting. If you want to be part of it, like, why not?
Yeah.
Why wouldn't you be here? Try to do something, whatever it is. Doesn't have to be digital. Like any sector. Like, pick any sector. Like, all of it is going through transformation, and also it's also unique to, and you look at the demography. Right, it's young populations. 80% below 80% population below the age of 35. Like here you go. You have a very strong
digitally active.
Yeah, digitally active, etc. You don't find this demographic construct in any other part of the world, right? So I mean, specifically Europe, right? So to give the example of Europe or maybe North America, So that's exciting, right?
Yeah.
So there is a feeling, like there's a feeling of something, like try to be belonging to like a bigger narrative, something that gives purpose. And I guess people who are purpose driven, not just money driven, people are drawn into these kind of stories, right? Yeah, I think this is one of the big reason why we feel this energy, this positivity, this everything's possible feeling now and here.
Absolutely, and with also this being one of the markets where the per capita income being high, so there is that willingness to pay, which perhaps in other countries it gets mitigated through a number of people, the population. So, and Dubai, UAE, the Sandpit that we call, and even the neighboring countries are welcoming new ideas, which perhaps, as you mentioned, a decade ago, we had only a few of them, but right now there is a proliferation of apps which are available. Like if you look at one particular sector of quick commerce, you'll have 3-4 options. If you look at electric scooters, you have 3-4 options. So it shows that there is enough room for many to exist or coexist, and there's a market for each.
I believe so, yeah. So a good way to put it.
Well, that's just about as much as we've got time for today. We're going to have to wrap up, but it's been an absolute pleasure having you on. So thank you very much.
Thank you so much for this.
Thank you.